In many ways, you might start to hear rather simple, perhaps even simplistic accounts of what is at the bottom of this current crisis. I suppose there will be those who will say it's all about this, X, Y, or Z, whatever their favorite idea is. I would tell you, based on my understanding of what's going on, these simple, even simplistic explanations, while they are very seductive, will almost always be wrong, or at least incomplete. This is a complex set of issues. There are multiple causes that have come together in creating this virtual tsunami. Let us be very clear, this is potentially very serious. I was talking to a dear friend, a former Nobel Prize nominee for the Economics Prize as recently as last year, and this was about 10 days ago, and he said, in my opinion, we are potentially at the brink of a precipice, the likes of which we have not seen since 1929. Of course, this was before various very sensible efforts started to get put in place with coordinated rate cuts by various central banks and other sensible steps. What are some of the themes? I actually want to go back to fundamentals of finance. As I said, although I'm not a financial expert, I understand enough about finance, and of course my colleagues who are the financial experts will speak to this in greater depth and detail. In many ways, there are some fundamentals of finance which people who frankly should have known better seem to have forgotten. Let me just mention a few. In some fundamental ways, this crisis originates in the mispricing of risk. The usual, the most simple account is that if you're a bank and I come to you as a customer and say, I would like to get a home mortgage from you, depending on how you calibrate my creditworthiness, implicitly the risk that I am as a person to whom you give a loan, you charge either a higher interest rate or a lower interest rate. I think in part the problems started to arise a few years ago in the US when loans were being given out. Some of them are called, by the way, ninja loans. This is not about Japanese martial arts, although it sounds like it. It's no income, no jobs, no assets. And you're giving out these mortgages, long-term debt given out. Of course, it's collateralized, so the house is there to back it up. But nevertheless, the interest rates being charged are much too low, and then the story becomes more complex. But this is one of the fundamentals, the mispricing of risk. Another fundamental, too much leverage. Too many people taking on too much debt which they did not have the capacity to service. Equally, on the other hand, and by the way, I'm talking mostly about the United States here, too many individual consumers taking on too many banking institutions lending out much more money than, in fact, is prudent. And frankly, the regulators not doing enough to monitor what was going on, which should have been their role and is their role. A third kind of fundamental has to do with this complex set of issues. You have read about collateralized debt obligations. You have read about credit default swaps. These are quite complex topics, but the theme I want to just sound, and if time permits, we'll come back to it at the end. While these are good, even interesting, very creative financial innovations, part of the problem, I believe, that has arisen is that no one was minding the whole store. No one was taking care of nearly enough the overall picture. So while you have these innovations taking place at the micro level, the amazing thing, when I started to read the numbers, it was almost mind-boggling. Credit default swaps, for instance, which is a way maybe some of my finance colleagues can explain in greater detail if you have questions later on. This is a way of a bank that has lent money to someone else, essentially carving out the risk of that loan, and this is now underwritten by a third party, almost like an insurance policy. As recently as 3 years ago, 4 years ago, the amount of these credit default swaps in the whole global economy was possibly less than $1 trillion. Last year, the overhang was $60 trillion. I find it staggering. And one day, when the loans start to default, the proverbial chickens start coming home to roost, someone will be left holding the bag, and that's behind a lot of the financial crisis that we have seen. Two quick points before I turn over to Lilian Ng. One is that in some ways what we are seeing now is that going beyond the economic fundamentals, the psychology of financial markets has taken hold. One of the things we have started to understand, in part, insights coming from a new emerging field called behavioral finance, is that stock markets reflect not just what is happening at the economic level, they also reflect deep interactions with the psychology of investors. One of the things that we actually know quite well is this interaction of the psychology of financial markets with the economic or financial fundamentals tends to have stock markets overshoot both on the positive side and on the negative side. So on the one hand, we see bubbles. We have seen some of that in recent years. On the other hand, we see absolutely bust cycles. By the way, if you truly have the courage, and if you have, it's sometimes a phrase is used, intestinal fortitude, this would probably be a very good time to be wading into the financial markets and buying blue chip assets on the cheap. I'm not suggesting financial advice for you. You have to make your own decisions. But this is certainly I'm looking to do myself. The other final point I would make is, and by the way, I approach these issues from a complex systems perspective, which is where some of the research that I have done has come from. Some of these failures, which are, when you look at it carefully enough, really are system-level failures. Some of these are inevitable consequences of the very interlinked and interdependent nature of the contemporary global economy. The analogy one might use is of something like the electrical grid of the entire United States. Some of you, I'm sure, are engineers or even electrical and power engineers. When you have a system of when you have an overarching system of interconnected subsystems which are tightly coupled to each other, as the coupling tends to get tighter, you go from failure at the level of subsystems to failure at the level of the entire system. And by the way, that also suggests that solutions will have to come by sheer logic at the level of the entire system, which is why some of the moves of the coordinated rate cuts across various countries is a move in the right direction. So those are just some initial thoughts. Let me turn now in sequence. My colleagues from the right will start speaking one after the other. And Lilian Ng, Professor Ng, would you please share your comments?
Good morning, ladies and gentlemen. Testing. Hi. I was born and raised in Singapore, and I've been away in the States for more than 20 years, and it's my pleasure to be here to share my views with you about the subprime crisis. As Dr. Sen has just mentioned, we are in the middle of an economic and financial crisis of our times, at least in my times. And the crisis has started in the US about 10 years ago. I mean, it started because of the rising prices of housing prices about 10 years ago. And what I'm going to do is to give you some perspective of what happened and then what had been done, and hopefully I can share my view as to what should be done at the end of the 5-minute discussion here.